Welcome to enrichminds.com and to our session on Forex or foreign exchange or currencies. In this session today, we shall learn about currency markets called Forex markets and how they can be traded and how we can use them in our portfolio to generate profits. The foreign exchange or Forex markets are where investors go to buy and sell currencies. Unlike the stock market, where investors buy and sell investments through an exchange, Forex trading is called an over-the-counter market. That means it is made up of an informal network of buyers and sellers, with investors typically making trades through a dealer. You can essentially trade any currency for any other currency through the Forex market by working with a dealer. To buy or sell one currency, you have to pay or receive a different currency. That's why currencies are always quoted in terms of pairs. For example, you could buy US dollars and pay for them with Chinese yuan. Or you could buy British pounds and pay for them with euros. Virtually any combination is possible. With daily trades of more than $5 trillion on average, the global Forex market is by far the largest market in the world, several times larger than the stock market. There are 180 different currencies in the world. The newest currency is the South Sudanese pound, which came into existence in 2011. So taking pairs of two, we can get 16,110 such pairs. In other words, 16,110 pair trades are possible in the Forex markets. Note that cryptocurrencies are not currencies in the traditional sense as we explain here. We shall cover cryptocurrencies separately in a later session. So now that we know Forex markets are the biggest market in the world, who trades in Forex markets? First, governments. Central banks or other government entities may trade currencies to try to influence the price of their home country's currency or to smooth out bumps in its price changes. Second, dealers. Large financial institutions make currency trades for their clients and may enter into their own trades as well. Third, corporations. If a company sells goods in the United States but is based in Germany, it may need to convert the US dollars it receives into euros. That means going through the Forex market. Fourth, investors. Large investors and small investors may make bets on currency price movements or may need to exchange currencies in order to make an investment in another country. Fifth, individuals. If you go on vacation or a work trip to another country and need to exchange currency when you arrive or leave, you're going through the foreign exchange market too. What drives prices of currencies? Currency price movements can be driven by the relative status of the following metrics between two countries. First, interest rates. Higher interest rates often drive a country's currency up. The country offering a higher interest rate will attract investors, driving up the value of its currency. Second, inflation. Higher inflation typically makes a currency fall. If a country is suffering higher inflation, its currency is likely to suffer. Third, economic growth. Higher economic growth tends to attract investors into a country, which makes its currency rise. The country with higher growth will have a more valuable currency. These are simplistic ideas, and the reality is far more complex. In general, it is demand and supply that drives the value of a currency. The value of the US dollar often defies these three fundamental rules because of the demand for US dollars. There is a fourth reason why relative prices of currencies can be impacted. This is the perceived status of that currency. For example, some currencies such as the US dollar or the Swiss franc are considered safe haven currencies that investors go to during uncertain or volatile geopolitical times. Let's watch a short video on Forex trading, courtesy of Investopedia.
Foreign exchange is the act of changing one country's currency into another's for tourism, commerce, or other reasons. As businesses continue to expand to markets all over the globe, the need to complete transactions in other countries' currencies is only going to grow. Fluctuations in currency value expose businesses to risk when they have to buy goods or services beyond their borders. Forex markets provide a way to hedge that risk by fixing a rate at which the transaction can be completed in the future. Investors can also buy or sell one currency against another in the hopes that currency will gain or drop in strength and result in a profit. That's called speculating. The interbank market includes banks from around the world that trade among each other. Supply and demand sets the prices in the market. Since between $2 trillion and $3 trillion in various currencies trade every day, no single central bank can move the market for any length of time without the help of other central banks. The pros of Forex trading include the ease of entering and exiting trades in most major currencies. Traders can use leverage to control large positions with little of their own money. Forex markets are open around the clock, and since it's a macroeconomic endeavor, trading currencies does not require understanding the nuances of microeconomic factors. Traders should view Forex trading as a chance to diversify. They can approach it as an active trader's opportunity to earn more spread, or as leverage trading where it's easier to work with a small amount of money than what's needed in the stock market. Forex traders should know how to time their trades with charts, and they should avoid impulsive behavior through the use of common sense.
The Forex market is a global network of currency trading. Unlike stock markets, foreign exchange trading is decentralized, with investors transacting with one another and through dealers. You can trade essentially any currency for any other currency in the Forex market. The Forex, or foreign exchange market, describes the informal network of institutions and dealers that facilitate currency trades. Currencies are always traded in pairs, with investors swapping one currency for another. Governments, corporations, financial institutions, and investors are all major players in the Forex market. Like commodities, trading in Forex is also quite risky and should be left to professional Forex traders. Thank you for your time, and until next time then, stay enriched and strong.